Let's get the big picture with Adam Parker. He's Chief U.S. Equity Strategist at Morgan Stanley. Adam sees the S&P closing the year out at 1238, so that's about a 7% drop from here. Adam, good to have you here with Matt and me on the close. Good afternoon. Let's talk about this macro environment. I mean, we're kind of surprised that the markets aren't selling off. Why do you think that is right now?
I still believe, and it's the Morgan Stanley house view, that you'll have some resolution in the next week, and I think people still believe that that's the base case. People aren't building in a breach in their base case at this point. So they're worried about it. They're certainly not building in the bear case at this point.
But you're still expecting a pullback, about 7-8% from where we are. Why is that?
My view is that the market multiple is going to contract. You think about where the market's going. You have earnings, and then you have the multiple, the PE, the ratio you're going to pay for those earnings. And if you really think about it, we have a lot of fiscal stimulus right now. We have a very accommodative monetary policy. And my stance is that either you remove some of that stimulus and hurt growth, or you don't remove it and you're still talking about issues with deficit/debt. So in the end, what happens is the market multiple contracts. And you've seen some of that unfold this year. In fact, in January, you were at about 13.5 times forward earnings for the market. Now you're around 12.7, 12.8. So you're seeing that slowly develop as people worry about those issues.
Adam, I want to go back to some of those macro issues in just a moment. Adam, let's talk a little bit about earnings. You were just talking about it. I mean, historically, though, if you look at the S&P 500, I think we're at a P of about 15. Five-year average is a little bit above that. I mean, you don't think historically that the market is still cheap, as a lot of our guests have said?
Actually, the facts are this. There's been forward earnings data that's existed since 1976. The average or the median since then is 13.1 times forward earnings. So sometimes that 15 number is a trailing earnings number. And I think, as you just saw with some of the earnings results, people are really more focused on the forward earnings estimate. So versus history, you're about the 43rd percentile right now, a little bit cheaper than average, but I don't think compelling enough in and of itself. If you strip out the biggest 30 companies in the market right now, the mega caps are certainly cheap, but the rest of the market's really about in line with that long-term average. So we don't see that in and of itself as particularly compelling.